3.
Hi there, I'm Patti Ogilvie from the Student Loan Help Group. I'm a senior enrollment counselor here.
And I'm Sam Pettingill. I'm also a senior enrollment counselor with the Student Loan Help Group.
And today we're going to review the federal repayment plan options and steps to qualify and apply for the programs. So I'm going to start out by asking Sam, what is a standard repayment? I know that individuals have many options for different repayment types. So we'll go over all the different options. And so Sam's going to explain about the standard repayment.
Okay. So just as the name implies, the standard repayment plan is the repayment plan that you're put on if you don't ask for any other options. So if you graduate from school and you have several different student loans, they'll all be put onto the standard repayment plan if you don't ask for anything else. The standard repayment plan is based on your balance, and for unconsolidated loans, it is a 10-year standard. So it's the amount that you would need to pay in order to pay your loans off in 10 years or 120 months, given your balance and your interest rate. Some of those numbers can be very scary, especially if you have a high balance. Just to give an example, if you had a balance of $100,000 at 6.8%, your standard payment would be $1,150 a month. So that can be a very intimidating and probably not very realistic payment. There is a little bit of misconception with the standard repayment plan too, that there is also a consolidated standard repayment plan. So if you had that $100,000 balance in 6 different loans and you consolidated your loans, and they put you on the standard repayment plan again, now you're not on the 10-year standard, you are on the consolidated standard repayment plan. That's important because the consolidated standard repayment plan is not a qualifying payment plan for programs like public service loan forgiveness. And the consolidated standard can take up to 25 years for you to pay the balance back, depending on the size of the balance. So it can be a lower payment, but it's still based on your balance and your interest rate. Now, there's other options besides just the standard repayment plan. So Patti, how does the extended fixed repayment plan and the extended graduated repayment plan differ from the standard plan?
So a lot of times when people are looking at the repayment options, they're looking at their lowest repayment option. They're not looking at how long something's going to take to repay. So for example, using the same figures that Sam did of that $100,000, using that same repayment plan that Sam just mentioned at $100,000 at 6.8% interest, the extended fixed repayment, just to give you guys an example, that would be lower than that $1,150 that Sam mentioned. It would be $694. But what you don't know is that that is amortized over 25 years. So it's going to take you 25 years to pay that off. And with principal and interest on that same $100,000, you'll wind up paying back over $208,000 in principal and interest, which is crazy because you only owe $100,000. Now, as far as the extended graduated plan, that's another option that people will go with because they just look at the lowest repayment option. But what they don't realize is that the extended graduated plan, that is going to adjust up every 24 months. And so, yeah, you have a lower payment. That same $100,000 that we were talking about, the payment would be $577. The payment would adjust up every 24 months. And again, it's amortized up to 25 years. And for that same $100,000, you'll wind up paying back over $222,000 in principal and interest. So huge amounts of money that you're paying back needlessly in most cases just to have a really low monthly payment. So Sam, I'm talking about these payments. What options are available for people who want to get on an income-driven repayment plan?
That's a great question, Patti. So for the income-driven repayment plans, there's generally 4 options. All 4 options aren't necessarily available to you depending on your balance and depending on the type of loans that you have. So the 4 different payment plans that are available as income-driven repayment plans, if you have direct loans, are revised pay-as-you-earn, income-based repayment or IBR, and income contingent repayment or ICR. Now, depending on when you took out your loans, it's possible you may not qualify for pay-as-you-earn. Pay-as-you-earn requires that you did not have a balance on October 1st of 2007. So people who have had their loans longer than that, that would not be an option. There also is the restriction that if you have what are called FFELP loans, so that is an older loan type that was discontinued in 2010, If you have FFELP loans, you are only limited to income-based repayment or IBR. That's something that we sometimes see. If you formerly had FFELP loans and then consolidated to direct loans, you might have kept yourself on the IBR, the income-based repayment, because it's what you're familiar with. But because that is actually calculated for older loan borrowers or for older loans, that is actually calculated based on 15% of your discretionary income rather than the 10% that say pay as you earn or revised pay as you earn would use. It ends up being more expensive than what you need to pay. So being on the right income driven payment plan is very important. The other one that's important to realize is that if you have Parent Plus loans, that's a situation we often talk to people who took out loans on behalf of their child. And those are our Parent Plus loans. Parent Plus loans are limited to ICR or income contingent repayment. And that tends to be the most expensive of the plans because that tends to use 20% of your discretionary income. Now, we talked about all these different income driven payment plans. There is one that is not income driven that we haven't mentioned yet, and that's the graduated repayment plan. So what is the graduated repayment plan?
So the graduated repayment plan is, again, it's not going to be counted as a qualifying repayment option if you are working towards one of the federal forgiveness options. But the graduated repayment plan, that's going to adjust up every 24 months. So you're going to start out with a lower payment, but you're going to wind up paying it over 25 years and you're going to be paying a huge amount of interest. You're going to wind up paying on that $100,000, $147,000 total in principal and interest. So I know most people make their decisions based on what the loan amount, the monthly payment is going to be, but that is not going to benefit you. It's just the Band-Aid. Now, one thing I did want to ask you, Sam, about the income-driven repayment plans, people try to do this on their own and they wind up picking the wrong repayment option. People don't know that there are more than one option. They just look that the one option is called an income-based repayment, an IBR. They think that that's the right repayment, but in actuality, they could be on a repayment plan that's going to allow them a lower payment based on their income and their household size, but they're not aware of that because they just think that, okay, I'm going to just grab this. So you and I worked out some figures here. So the example that Sam and I want to use is for these income-driven repayment plans, they're always based on your income and your household size. And so let's just say that you were single, you had an income of $50,000 and you had a household size of 3. What would the different amounts be, Sam? Just so somebody can get an idea of making the incorrect choice is going to cost them.
Yeah, absolutely. So for that example that you just gave with an income of 50,000 and a household size of 3, if you were looking at, for example, pay as you earn or revised pay as you earn, which both use the same calculations, that would be approximately $161 a month. If you're talking about income-based repayment, so the example that we just gave where you've been on income-based repayment and you stay on it, you don't realize there's a better option, your payment would be $242 a month instead. So that's about $80 a month that you're paying over what you would need to pay as a single borrower. You don't need to be on income-based repayment.
That's a big difference.
That is. And I've seen that number be as high as $130 a month difference between income-based repayment and that revised pay as you earn or pay as you earn. So that's very important to be on the right plan.
Right.
And then if that balance, say you had the income of 50,000, a household size of 3, but these were Parent Plus loans, and now you have to be on income contingent repayment. At that point, your payment would be $493 a month because income contingent repayment does take into account to a limited extent the balance. So the fact that you had $100,000 of Parent Plus loans, you would be looking at $493 a month.
Wow.
So huge variation there.
Really is big difference. So it's important for somebody to know what option to choose because it's just taking money out of their own pocket as well as decreasing the amount of forgiveness that they're going to get at the end of all this.
Absolutely. Yeah, it's very important to have the right repayment plan for the strategy that you need to use, whether that's, if you have public service employment or if you're going for income driven repayment forgiveness, it might change the calculation about what you're using. So
when it does come to somebody selecting the correct repayment plan, what are some things that they should consider or what advice would you give them, Sam?
Well, I think the most important thing would be to have the guidance of an expert. These plans are complicated when you try to do it on your own. You can make mistakes that you don't even realize. There's so many dates and technicalities in qualifying for the different plans and the different forgiveness programs that it's easy to make mistakes. So it would definitely help to have expert advice.
Excuse me.
No, go ahead.
I think too, some people are under the misconception that their servicer is going to tell them exactly what to do and they're going to pick the best plan and get it to them. But that's not the case, is it?
No, it's absolutely not. And I can tell you sometimes, even if you do specify you want a particular repayment plan, you need to follow up because your servicer may not give you the payment plan you asked for. Just as a personal example, right before I started here, I renewed my income-driven repayment plan. I'd been on revised pay-as-you-earn for years, and I wanted to stay on revised pay-as-you-earn. So that's what I checked on my IDR application. And when I checked into my loans recently, because the CARES Act is ending soon, Nelnet, my servicer, had actually put me on IBR.
Oh, wow.
I didn't request IBR, and that's definitely going to be a higher payment for me. So that's something I'm going to have to go and clear up, myself. But that's something that I never would have. I would have just assumed I got the payment plan that I asked for.
Right.
So that's definitely something to keep an eye on.
Right. Okay. Definitely good to know. Definitely good to know. And I think that's all I wanted to ask you about that.
Okay. So, I mean, as far as, the income-driven repayment plans, it's really not something that you can't just expect it to continue on forever. It's something that has to be renewed. So how often should people renew their repayment plan?
So Sam, every year, an individual would have to recertify their income and their household size and their employment if they're working towards one of the forgiveness programs. And if they're not working towards one of the forgiveness programs and they just want to have an income-driven repayment, they can do that as well, but that's still going to require being updated every single year because the payment is always going to be based on that information. If something changes, then that payment could adjust up or down accordingly. And if you don't keep up with it, the lender, the servicer, the DOE, they're just going to slap you into a standard repayment and you won't even know it until you get the bill. In this case, on that $100,000 for $1,150, thinking that your payment was going to be $160. So yeah, you'll be in for a big shock.
Definitely.
And Sam, which repayment options offer the lowest payment plans?
So that really depends on your loan balance, your income, and your household size. For some people, I have seen if you have an extremely low balance, I've seen ICR end up actually being the lowest payment because if your balance remaining is say $10,000, you may end up having a payment of only something like $75 a month, even if you do have a higher income. For some of the repayment plans, if you're not worrying about qualifying for the forgiveness programs, it's also possible for a smaller balance for the standard payment to be lower than an income-driven payment, again, depending on your income and your household size. If you're just talking about which of the income-driven payment plans is the lowest, it's generally either pay-as-you-earn or revised pay-as-you-earn, depending on your tax filing status. They calculated based on a lower number, so they tend to be the lowest of the income-driven payment plans if all other things are the same.
And there are a lot of different requirements for the different repayment options. So definitely important to speak to somebody like you're saying, who does actually know what's going on. Because when we speak to somebody, we're going to figure it out all ways, as married filing jointly, married filing separately, and we're going to figure out which way is going to get them the most forgiveness at the end of all this. So important to note.
And keep their payment the lowest as they're moving through the process, which is always important.
Right.
So what if you're in a situation where even the income-driven payment is just not an option for you? For whatever reason, you have financial circumstances going on and the income-driven payment is not going to be affordable. What are the steps for applying for financial hardship?
So each person on their loans starts out with 36 months of forbearance and 36 months of deferment that they can use should they find themselves in a hardship situation. And they would apply for that through their servicer. One thing to keep in mind is that any time in deferment or forbearance is not going to count as a qualifying payment if you're working towards public service loan forgiveness. So important to note. Also, you're still going to be accruing interest if you do put yourself in general forbearance or deferment, which a lot of people are under the misconception that they don't accumulate interest. And that's not the case. And for most people, that's the reason why their loans balances have grown so exponentially, is because they keep putting themselves in general forbearance or deferment.
Yes.
And so, Sam, I'm sorry, but where can people find more information relating to the student loans and federal repayment plans?
Well, there is some information available on the federal student aid website. Some of it can be a little bit difficult to decipher. I feel like the best option would be, if they do have questions, would be to set up an appointment, a consultation with one of us. We'll be able to go over all of your options. And then, as you said, analyze all the different options you might have. If you're looking at filing jointly, filing separately, what payment plan option would give you the lowest possible payment in your situation?
I think that's good advice for sure.
Mhm.
So we appreciate you guys viewing and taking all this into consideration. And the next time we do this, we're going to go over some student loan myths. So keep an eye out for our next session, you guys.
Absolutely. It's been a pleasure. Hopefully this is helpful information. And if you have questions, just write them down so you can ask them to us at our consultation.